Welcome to my channel. Today I took a topic from financial management and the topic is financial statement analysis. Financial statement analysis is very important to prepare for the company final report. So in that the main thing is your ratio analysis, common size statement, importance and limitation of ratio analysis and mini cases. Ratio analysis. Ratio analysis is a widely used tool for of financial analysis. It is defined as the systematic use of ratio to interpret the financial statement so that the strength and weakness of the firm as well as its historical performance and current financial condition can be determined. So, basic of comparison. Trend analysis involved comparison of a firm over a period of time, that is present ratio are compared with the past ratio for the same firm. It indicates the direction of change in the performance, improvement, deterioration or consistency over the year. Interfirm comparison involves comparing the ratio of a firm with those of others in the same line of business or of the company as a whole. It reflects the firm's performance in relation to its competitor. So, common size income statement, comparative income statement, comparative balance sheet, common size balance sheet. There we are able to compare the data, the company inside for 2 years, 3 years data. So, comparison with standard or industry average. Types of ratio. Types of various type of ratio is there, but first broadly classified is the liquidity ratio, capital structure ratio, profitability ratio, efficiency ratio, integrated analysis ratio and growth ratio. Net working capital. Working capital is your current asset over current liability, current asset minus current liability. So net working capital is measure of liquidity calculated by the subtracting current liability from current asset. So net working capital, if we have to calculate, we should know total current asset for, let example, for two company A and company B. So what is my total current asset? Then total current liability. So we are able to minus current asset minus current liability and we will get the net working capital. So change in net working capital if I want, again I will take company A and company B data and I am able to calculate the working capital. First ratio now, liquidity ratios. Liquidity ratio measures the ability of a firm to meet its short-term obligation. Liquidity ratio is for the less than 1 year. So, in the liquidity ratio, the first will be your current ratio. Current ratio is your measure of liquidity calculated dividing the current asset by the current liability. So, current ratio formula is simple, that is current asset by current liability. And for if current ratio will be 2:1, that is good for the company. Key means you have a double of your liability, asset is double of your liability. So that's why 2:1. Here it is given like a particular firm A and firm B. My current asset for firm A is 1,80,000. For firm B it is 30,000. So current liability is 1,20,000. Here 10,000. So my current ratio is here 3/2. So that is the 1.5:1. And here it is 3:1. So generally the preferable current ratio is 2:1. So current ratio is your current asset divided by current liability. Second is your acid test ratio. Acid test ratio, other name is quick ratio. So quick ratio and acid test ratio is same. So it is that the difference of liquidity of the component of current asset. So acid test ratio or quick ratio is your quick asset by current liability. Quick asset is nothing but is your current asset minus stock minus prepaid expenses. So that is always the ratio is optimal for 1:1. So quick ratio is your quick asset by current liability. Or what is quick asset? Current asset minus stock minus your prepaid expenses or stock or inventory. Example. For example, cash. If you have 2,000, debtors 2,000, inventory is 12,000. So your total current asset is 16,000 and if your liability is 8,000, so here your current asset is, current ratio is current asset divided by current liability. So that time it is 16,000 by 8,000. So my current ratio is 2:1, and my asset test ratio or quick ratio is current asset minus my inventory. So current asset minus inventory, if I will calculate it this one, I'll get here 4,000 divided by your 8,000. So I'll get it here because here cash is there, debtors is there. So what I will do here, my liability is your 8,000. That will be same. So here what I have to do, here I have to divide or minus all that. So I will get this. So my asset test ratio is 0.5:1. Supplementary ratio for liquidity. That is your ITR, inventory turnover ratio, DTR, debtors turnover ratio, and CTR, that is your creditors turn ratio. What is inventory turnover ratio? It is very important ratio. So this ratio indicates the how fast inventory is sold. So high ratio is good for the viewpoint of liquidity, and vice versa. A low ratio would be signify that inventory does not sell fast and stay on the shelf or the warehouse for a long time. So inventory turnover ratio is your cost of inventory sold divided by average inventory. What is average inventory? That is your opening inventory plus closing inventory divided by 2. So COGS, cost of goods sold divided by average inventory. So now cost of goods sold means what? Sales minus gross profit. So these formula you should know, because if you have sales and gross profit, you are able to calculate the COGS. And if you have a average inventory, if you don't know, you then opening and closing inventory average. So this is ITR ratio is very important. So that is cost of goods sold by average inventory. For example, inventory turnover ratio, a firm has sold good of rupees 3 lakhs with a gross profit of margin 20%. The stock at the beginning and the end of the year is given 35,000 and 45,000. What is your ITR? So I know that ITR, how to we are able to calculate? Whatever is my inventory, that is 3 lakhs minus 20% of the gross profit. So that is 60,000. So 3 lakh minus, because if I have to calculate cost of goods sold as previous one, so cost of goods sold is your sales minus gross profit divided by average inventory. So 3 lakhs is sales minus cost of goods sold is 60,000 divided by opening inventory plus closing inventory divided by 2, that is your average inventory. So here my ITR is 6 times per year. Inventory holding period, if I have to calculate, I have to always calculate, like if I am having ITR, so always for the 1 year point of view, that is 12 months divided by ITR. So I am able to calculate it here 2 months. Debtors turnover ratio. Debtors, the ratio measures how rapidly receivables are collected. A high ratio is indicative of shorter time lag between credit sales and cash collection. A low ratio shows the debt are not being collected rapidly. So what is my debtors turnover ratio? Net credit sales. Because I told about here, whatever the time lag between the credit sales. So net credit sales divided by average debtors. So net credit sales consists of your gross credit sales minus return, if any, from customers. And average debtor is again in your simple average debtors, that is your including bills receivable at the beginning and end of the year. Example, a firm has credit sale 2,40,000 during the year. The outstanding amount of a debtors at the beginning at the end of the year is given 27,500 and 32,500. Determine the debtors turnover ratio. So I know here the credit sales is given 2,40,000 and opening and this one is starting and ending period, the value is given. I'll take the average. So I'll get here 8 times per year. So if I have to debtors, because why? Because previously we had done inventory turnover ratio and inventory collection period. The same thing is here, debtors turnover ratio and debtors collection period. So debtors collection period means again it is 12 months divided by what is debtors turnover ratio. So I got the value 1.5 months. Creditor turnover ratio. Again here it is based on your how much credit terms granted by suppliers. So a low turnover ratio reflect liberal credit terms granted by the suppliers. Uh, While a company high ratio shows that accounts are settled rapidly, the creditor turnover ratio is an important tool for the analysis of a firm can reduce its requirement of current assets by relying on suppliers' credit. So my creditors turnover ratio is net credit purchase divided by average creditor. Same thing, net credit purchase is what? Whatever my gross credit purchase minus return to the suppliers. So average creditor is your average creditor include again whatever including bills payable. So that is outstanding at the beginning and at the end of the year. Example, the firm having again credit purchase of rupees 1,80,000. So the amount payable to the creditor at the beginning and the end of the year is given. So you have to calculate the creditor turnover ratio. So I know that creditor turnover ratio, what I will do here? Formula net credit purchase by average creditor. So here again I am having a value. So that value, sorry, the value is given here 1,80,000 and this here value the given 45,000, 42,500 and 47,500. So I am able to calculate the average. So I will get the value that is 4 times per year. So creditor period again 12 months divided by credit turnover ratio. I will get the value. The summing up of these three turnover, known as cash cycle, has a bearing on the liquidity of a firm. The cash cycle captures the interrelationship of sales, collection from debtors, and payment to the creditors. These things actually very important for the working capital requirement, because we know that working capital is your current asset minus current liability. So in current asset, whatever the things will come, and liability, whatever the things come, on the basis of that, we are able to calculate. So here the combination of effect of these three turnover is summarized, like inventory holding period, if it is given based on the previous that sum, it was a 2 months, and at the debtors collection period was a 1 month we calculated, and less the creditors payment, here it's given like it is 3 months. So here I got it 0.5 month. So as a rule, the shorter is the cash cycle, the better are the liquidity ratio as measured above and vice versa. So please refer this PPT, because here you will get the clear idea ki where these three turnover ratio, inventory turnover, debtor turnover and creditor turnover ratio we are using, and how I am able to sum up the collection, and how I am able to say that how the cash cycle will be formed. And as a rule, the shorter is the cash cycle, the better are the liquidity ratio as measured above the and vice versa. Now next is your defensive interval ratio. Defensive interval ratio is the ratio between quick assets and projected daily cash requirement. So here defensive interval ratio is your based on your liquid asset divided by your projected daily cash requirement. So how it is a projected daily cash requirement you will get? Whatever your operating expenses divided by number of year in a year. So basically we are taking 365 days. Example, a projected cash operating expenditure of a firm from the next year is 1,82,500 and it has a liquid current asset amount of rupees 40,000. You have to determine the defensive interval ratio. So I know my value, the operating expenses divided by number of years. And if I want to calculate the interval, I know amount of current asset divided by whatever the projected daily cash requirement. So I will get the number of days. Cash flow from operation ratio. See, cash flow from operation or financial ratio, all that is very important. So cash flow from operation ratio measure the liquidity of a firm by comparing actual cash flows from operations with current liability. So cash flow from operations ratio is whatever the cash flow from operations you are getting divided by your current liability. Next, this is very important ratio, that is your leverage capital structure ratio. So there are the two aspects of the long-term solvency of a firm. First, ability to repay the principal when due and regular payment of the interest. Because when you are making your income statement, that time also you should know whatever your sales less your variable cost, you will get your contribution less your fixed cost, you will get your EBIT, earning before interest and tax. Then again from there you have to first pay your interest. So you will get your EBT or PBT, profit before tax, or then after that you have to deduct your tax. You will get EAT or PAT. That is your final profit. And if you have a company is paying dividend to their shareholders, in that case you have to minus the dividend. And at last, whatever you will get, that is your earning available to equity shareholders. That is your actual profit. And from that only you are able to calculate your EPS. So that's why the leverage capital structure ratio is important, because in the leverage, how with the help of the fixed cost, you are able to maximize your profit. So leverage is generally three types: operating leverage, financial leverage, and combined leverage. And if you have to calculate the leverage, you should know the income statement. So that's why in the long-term solvency of the firm, the first you should know ability to repay the principal when due, and the second, regular payment of the interest. So capital structure or leverage ratio throw light on the long-term solvency of a firm. Accordingly, there are two types of leverage ratio. That the first one, these ratio are computed from the balance sheet, and the second, these one I just spoke about, that it will be taken from the income statement. So if the leverage is computed from the balance sheet, it is again three type. That is your debt equity ratio, debt asset ratio, equity asset ratio. And here it will be interest coverage ratio and dividend coverage ratio. This is very important part. So first we will talk about uh, debt equity ratio. Debt equity ratio measures the long-term or total debt to shareholders' equity. Debt equity ratio, simple formula: whatever your total debt, that is your long-term debt, short-term debt, whatever your other current liability, means whatever your total external obligations divided by your shareholders' equity. So if the DE ratio, debt equity ratio is high, owners are putting up relatively less money of their own. The meaning is that, because when we start the company, capital structure is very important. Capital structure means what is your debt and equity combination. So, and that is which is the optimum. So based on you that requirement, you require that. So what is the equity proportion and what is the debt proportion? So here, if owners value, that it says that if the debt equity ratio is high, the owners are putting up relatively less money of their own. Means they have less equity there and they have more debt or debenture. So it is dangerous signal for the lenders and the creditors. If the project should fail financially, the creditors would have heavily lost. So, and the same thing, if the low DT ratio has just opposite implications to the creditors, a relatively high stake of the owners implies sufficient safety margin. So they are able to protect their asset. For the company also, the servicing of a debt is less burdensome, and consequently its credit standing is not adversely affected. Its operational flexibility is not jeopardized, or it will be able to raise additional funds. So the disadvantages of low debt equity ratio is that the shareholders of the firm are deprived of the benefits of trading on equity or leverage. Trading on equity. Trading on equity or leverage is the use of a borrowed fund in expectation of higher return to equity holders. Trading on equity, this is a format like your total asset is given for like for A, B, and C and D, and whatever your financial pattern like equity capital, and here it is given like debt. Here no debt, here debt is given. So just I spoke about, this is nothing but this is a simple income statement. Trading on equity means for the leverage we are using that. Total asset is given. What is your capital structure means financial pattern. It is a company's debt equity ratio that is given. So if you minus, you will get your EBIT. If you got your EBIT is constant, less your interest. Because if you don't have debt here in the first condition, no need to pay interest. But in the second and third condition, if you are paying 15% of 200 and 15% of 400, 15% of 800, you got the value. So if you minus this, you will get your EBT. I just talk about ki how from the sales I have started ki sales less variable cost is your contribution, less your fixed cost is your operating profit, that is your EBIT. But here if it is total asset is given for trading on equity, so you should know that your asset is no, your financial pattern you know. So if the EBIT is given fixed, so you have to check first you deduct your interest, then you will get your EBT or PBT. Then tax if it is given like 35% based on this, you have to calculate it. You will get your EAT or PAT. Then that is your return on equity. So how to calculate return on equity? Based on this value. So that is very important. You have to calculate that. Okay. So ROE is in percentage you calculated. So now debt to total asset ratio. Debt to total asset ratio is total debt by total assets. So proprietary ratio that indicates the extent to which assets are financial by owner's fund. And proprietary ratio is your proprietary fund divided by total asset into 100. This capital gearing ratio is very important for any company and basically for the financial company, because capital gearing ratio is used to know the relationship between equity funds net worth and fixed income bearing funds, that is your preference shares, debenture or other borrowed fund. Debt to total capital. The relationship between creditors fund and owners capital can also be expressed using debt to total capital ratio. So debt to total capital ratio is very, see, for any ratio, it is very easy to find the formula. How? The starting part is always your numerator and your ending part is always your denominator. So here debt to total capital ratio means total debt divided by your capital. Total capital, that is your permanent capital. So permanent capital is what is your shareholders equity and long-term debt. That is your permanent capital. Left hand side in the balance sheet, if you go for the vertical or horizontal balance sheet, horizontal means left hand side is your liability, right is your assets. If you are going for vertical, so up is your liability and down is your asset. So your total permanent capital means whatever your shareholders equity plus your long-term debt. Coverage ratio. Interest coverage ratio measures the firm's ability to make contractual interest payment. The company is able to pay interest or not. So that interest coverage ratio is very important. That is a simple formula for interest. Just we talk about income statement. What? EBIT. Less your interest, you will get your EBT. So interest coverage ratio is your interest, means your EBIT divided by your interest. Same thing your dividend coverage ratio. Because I told in the starting the company, whatever they are paying dividend to their shareholder, that will come after deducting the tax. After EAT, you have to distribute the dividend. Last, you will get your final actual profit. And from that, you are able to calculate the EPS. So, dividend coverage ratio is measures the firm's ability to pay dividend or preference shares which carry a stated rate of return. So dividend coverage ratio is also same thing. What? Your EAT or PAT divided by your preference dividend. So this is very important, and I gave in a easy way all the formulas you are able to memorize. Debt service coverage ratio. Debt service coverage ratio is also very comprehensive and apt measure to compute debt service capacity of a business firm. So generally it is not frequently they are using. So that is your EAT plus your interest plus depreciation outstanding set divided by your installment. Debt service capacity means the company's ability of a firm to make the contractual payment required on a schedule basis over the lifetime of the debt. Profitability ratio, common ratio. Profitability ratio, how you are able to measure the profit. So profitability ratio can be computed either from sales or investment. So profitability ratios related to sales, that is profit margin, expenses ratio, and profitability ratio related to investment, that is ROI, return on investment, and ROS or ROE. So return on shareholders equity. So this profitability ratio is very important. So first is your in the profitability ratio is your profit margin. That is a gross profit margin, net profit margin. So gross profit margin is what? how you are able to measure the percentage of each sale rupees remaining after the firm has paid for its good. So gross profit margin is your gross profit by net sales into 100 or gross profit by sales into 100. Same thing, net profit margin is your net profit by sales into 100. See, net profit margin is the next, what I told. Net profit sales. So net profit margin measures the percentage of each sales rupee remaining after all cost and expenses, including your interest and tax, have been deducted. So net profit margin can be computed in three ways. First, use your operating profit ratio. That is, again, this is EBIT by net sales. See, for income statement is very important to calculate the ratios also. And while preparing a financial statement, the ratios play the vital role. So operating profit ratio is your EBIT by net sales. Then pre-tax profit ratio means what? EBT by net sales. And net profit ratio means whatever your again EAT, earning after interest and tax by net sales. So these things, operating profit ratio means operating profit is your EBIT. Other name is operating profit. So by net sales, pre-tax means EBT by net sales, and net profit means after deducting your interest and tax by net sales. For example, here it is given gross profit and net profit you have to calculate. Sales is given, cost of goods sold, and other operating expenses. So gross profit, I know what, whatever your gross profit by net sales into 100. So gross profit margin is given what, 1 lakh divided by your total sales is 2 lakhs. You will get it. Net profit margin is again whatever your expenses by total sales into 100. Expenses ratio here, cost of goods sold, cost of goods sold by net sales into 100. Operating expenses means whatever your administrative plus selling expenses by net sale into 100. Administrative expenses is your administrative expenses by net sale into 100. Whatever they will ask you, that you have to write in a numerator by net sale into 100. Selling expenses by net sale into 100. Operating ratio, cost of, what is the operating ratio means whatever your operating profit. So operating cost of goods sold plus operating expenses by net sales into 100. Financial expenses means ratio is financial expenses by net sale into 100. So all expenses ratio, cost of goods sold or operating, admin, selling, operating ratio or financial expenses, everything will be numerator and divided by net sale into 100. Return on investment, ROI. ROI is very important for any organization. So return on investment measures the overall effectiveness of management in generating profits with its available assets. So here only it is both the ratio, and very important, if you want to invest in share market or stock market for a particular stock, you should know that what is your ROI. You should know what's the company's ROA, what's the company's ROE, what's the company's ROCE. So there ROA is your EAT, earning after tax. Then again your interest minus your whatever the tax on interest divided by your total assets. Same thing, return on capital employed. So that is again your EAT minus, this one is totally same. EAT, interest minus your tax on interest, divided by here whatever your average total capital employed. Average capital employed is what? Your whatever your total, that is your equity plus debt. So that is your total capital employed. From that average of total capital employed, you are able to calculate ROCE. Again, return on shareholders equity, that also measures the return on owners, that is your both preference and equity shareholders investment in the firm. So return on total shareholders equity means whatever net profit after tax by average total shareholders equity into 100. And return on ordinary shareholders equity, only for ordinary share, equity share. For that again net profit after tax minus, that time you have to minus your preference dividend, how much you are paying the dividend to your shareholders, that preference dividend divided by average ordinary shareholders into 100. Dividend yield like of Reliance during the 7 years given 5 to 12, ki how the earning yield and dividend yield of Reliance they gave for the year wise, and how you will take the mean of like 5 to 12 or 2 to 8. So this is given like earning yield whatever they gave and dividend yield. So on the basis of that we are able to find this. Then efficiency ratio, that activity ratio measures the speed with which various accounts or assets are converted into sales or cash. So ITR measures the efficiency of various type of inventory. So ITR, already we know, inventory turnover ratio is cost of goods sold by average inventory. Raw material turnover is, see, raw material, work in progress, then finished goods, then your debtors, then your cash. This will all will give you total current asset, and then your creditors and whatever you are paying, that all if you will do, that is your liability, and if you minus, you will get your working capital. So if raw material turnover means whatever your cost of raw material used divided by average raw material inventory, and the work in progress of the same thing, whatever the cost of goods manufactured by average work in progress inventory. Debtors turnover ratio, already debtors turnover ratio we know, that is the liquidity of the firm's receivable can be examined in two way. Debtors turnover ratio is what? Whatever your credit sales by average debtors plus your bills receivable. And same thing, average collection period, whatever in the month divided by average debtors. Already we had done earlier this. So aging schedule enable analysis to identify slow paying debtors. Asset turnover ratio, uh, again, it is the efficiency for the firm uses for all its asset and generate sales. So total asset turnover is cost of goods sold by average total assets. Fixed asset turnover is cost of goods sold by average fixed asset. Capital turnover ratio is again cost of goods sold by average capital employed, that is your asset liability. Current asset ratio is again turnover is again cost of goods sold by average current asset. Working capital turnover ratio is again cost of goods sold by net working capital. So asset turnover ratio, all is given. Here all the, these are the very important ratios, because when I want to invest for the share market, first I should know what is the company's EPS, how the company's return on equity, that is your here EAT by average total shareholders equity, how the company's equity fund, like here if I want to know about the ordinary, so already we had done earlier, this is a revision, EAT minus preference dividend by average ordinary shareholders, how to calculate the EPS based on your net profit or a net earning available to equity shareholders divided by number of equity shares outstanding. Then DPS, dividend payout ratio paid by number of equity shares, so DPS. Then if I have to calculate earning yield, so EPS by MPS, earning yield, that is your EPS by market price per se, that is MPS. Then dividend yield, DPS by MPS. DP ratio, that is very important, DPS by EPS. P ratio, that is MPS by EPS, market price per share, and book value per share, ordinary shareholders divided by number of shares outstanding. These 9 formulas are very important if you want to invest for in a share market, and if you want to know company's growth, you have to go through in this way. Because, and if you in the now the in the next classes also I will tell you about, if you want to calculate like dividend theory, if you study, so how to the company is paying dividend to their shareholders, so that time also Walter approach, Gordon approach, Modigilani and Miller approach, we should know about this formula. DPS, DP ratio should be given. Dividend payout ratio for the company payout is given, so that that time we should know what is the company's DPS, what's the company's EPS. If EPS is not given and profit is given, so I should know that net profit available to equity share by number of equity shares, so I have to calculate. Then if DPS is not given and dividend yield is given, so I should know ki how to and MPS is given, so how to I have to calculate DPS. P ratio, ki MPS by EPS, very important. And these the company's P ratio will know about ki how the company's market price per share and how they are equating with the EPS. So these things is very important. If you know this, so you are able to invest for any particular share also. That's why it is very good. Ratios, if you know few ratios like 14 to 15 ratio, and if you will read company's financial statement, you are able to make it know that ki, okay, this company will be in the long term, it will be give the profit or loss, what's a P ratio, that is very important. And if it is high or low, how, where I have to see, what I have to see. So if you want to know any means related thing regarding the stock market, please write in the comment box, so I will make new videos based on how you are able to analyze about the company on the basis of these ratios. Integrated analysis ratio, so integrated ratio provide better insight about the financial and economic analysis of the firm. So ROA, that is written on asset, that is your based on your return on margin and asset turnover. ROE, that is how to calculate EAT by sales into sales by asset by equity. So these formulas we are able to know about companies better insight about the financial and economic analysis. So you should be thorough about this. So ratio actually it's a very important part in your financial management and as well as in your financial accounting. So in the management accounting, generally we are study about the ratios, but in MBA, in the first sem, you have to study everything related to this. So now return on rate of return on assets, it is your EAT as a percentage of sales. So how the EAT, then again it is by divided by sales. Then again how the EAT will come, gross profit equal to sales less cost of goods sold minus these expenses minus this income tax. Same thing here, return on asset turnover, that is sales divided by total asset. So that total asset means what? Your fixed asset plus current asset. Then again, alternatively, what? Otherwise, you can do that shareholders' equity plus your long-term borrowed fund plus current liability. Return on asset means earning power is the overall profitability of the firm is computed by multiplying net profit margin and total turnover. So this formula earning power is given ki how the EAT by sales into sales by total asset into EAT by total assets. So here one example is given ki how you are able to make your net sales is given, so net profit, and how you are able to calculate the ROA. ROE again it is the product of the following three ratio, that is again already we discussed net profit ratio into asset turnover into financial leverage by equity multiplier. So here the three component model of ROE is given ki EAT by EBT into EBT by EBIT into EBIT by sales. So if you cut this one, so you will get your EAT or net profit by sales. So as a result of these three subpart, ROA is composed in the five components. So you should know about this so you are able to calculate the return on equity. And here, five ways to break up the enable the management if the value is given. So just please go through this. So here, all the things I given one example. Ki if you have net sales for A and B, how the less operating expenses, you will get your EBIT. Less, this is the income statement. I so told already, less net sales. Here it is operating expenses. So this one otherwise variable cost. So contribution less fixed cost. So your EBIT. But here directly it is net sales and minus operating expenses. You will get your EBIT, that is your operating profit. Less here the company took 8% interest. So here it is a given, and then less tax, you will get your EAT. Total asset of the company is given. That is, I think here it is given 4 lakhs or something. So that is given. So you are able to calculate your ROE. Common size statements. So preparation of common size financial statement is the extension of ratio analysis, because here nothing but it is a very simple calculation. These statement convert absolute sums into more easily understand percentage of some base amount, and always we are taking the current previous year as a base year. So it is a sales in the common income statement and total asset and liability in the case of balance sheet. And limitation, so ratios and this is a view of several limitations should be considered only as a tool of analysis rather than and the end of the itself. And the reliability and significance attached to ratios, which will be largely hing upon the quality of data based on that, and they are very good and or bad as the data itself. So it is they are very important tools of financial analysis. Thank you for watching my video. If you like, subscribe, and if any query, please write in the comment box.